background, I want to give a huge round of applause. Can you join me in doing that? Keep it going. You guys can sit if you want. See, life is about perspective. To you guys, you just clap for the people who put this on. For all my friends at home, they're going to think I got a standing ovation. So thank you for that. I appreciate that. Now, my name is Asher Molino. I work with annuities.
Yep.
When I say that, sometimes people look at me like I just said a bad word, right? You ever get that feeling if you talk to a client about annuities? The second you mention it, like you're a vampire. Shut the door, shut the door. And the truth is, we did a deep dive into this about like a month ago. A couple agents were there. You heard me talk about it, but a lot of the negative press we see about annuities, where did it come from? Well, it came from places that had a financial interest in pushing people away from them. Right? Some of the places that put out articles saying, hey, here are the top X reasons why annuities are a bad deal for you. They came from a financial advisor lead generation website. Right? Go figure. And I forget who has the quote, you know, there's no such thing as bad press. Whoever said that has clearly never tried to sell an annuity.
True.
But then sometimes I mention annuities and I'm talking to agents and they will get a little scared. And it's understandable. When we're talking about annuities, we're talking about moving someone's life savings, basically. But their whole life, what they've been building for retirement, we're talking about moving it, hundreds of thousands of dollars. And it can be something that's nerve-wracking, but the truth is, it doesn't take an expert to know that annuities are a good deal for your clients. That's why they like having me up here, because I look about 16 years old. You guys are probably wondering if my mom knows that I left the house.
No, she's in the back.
She's in the back. That's my mom. But here's the truth. It doesn't take an expert. Right? And I want you guys to pretend with me for a moment. Close your eyes and let's pretend we're walking through the parking lot. And just outside here at the Strat, and we're walking and we walk by Mr. Cody Askin's beautiful orange Lamborghini.
Yep.
And he has a lot of different colors. He just likes to drive the orange one on Tuesdays. And we keep walking and we walk by Mr. Darren White's Tesla Cybertruck.
Yep.
Right, and that thing's looking like a spaceship.
Yep.
He's got multiple different Cybertrucks. This one is just a beautiful shade of gray. And we keep walking, and we walk past my old beat-up 2001 Toyota Corolla. Oh, I'm telling you guys, you don't know the definition of persistence until you've seen that Corolla. I have full faith that I will probably die after that thing does, or before that thing does. 300,000 miles and counting. And I'll tell you guys, I've never driven a Lamborghini. And I'm going to pick on somebody here. If I could pick on you, ma'am, have you ever driven a Lamborghini? If you got behind the wheel of one right now, would you know how to drive it? More or less, I'm willing to bet you would know how to drive it. You'd know how to put it in reverse. You know how to drive it forward. You know how to brake, right? You could probably figure out the windshield wipers. And it's not because you've driven a Lamborghini before. I certainly haven't. But it's because you've learned how to drive just one car. And that is the secret that I'm talking about, because there's 100 annuities, 1,000 annuities out there. It can seem daunting and overwhelming to try to figure out what's best for your client. But the secret is, if you learn just one annuity, one illustration, more or less, you have learned them all. And don't get me wrong, there's differences and there's nuances. But for the most part, a lot of annuities set out to answer the same questions for clients. And it's for a good reason. Once we get to retirement, there are a few basic things that we are most concerned about. Right? Number one, is my money protected from the stock market? Right? We were talking about that earlier. Mr. McDonald was saying that's one of those things you just can't control. And especially in retirement, I know a lot of retirees would rather stick their money in the bank where it's earning 1/10 of 1% than keep it in the stock market, because they don't want to risk it. So number one, retirees want to know that they're putting their money in a place where they can't lose if another 2008 happens, right? Or if another 2000 dot-com bubble burst happens. They want to know that they have a chance to actually earn some interest, right? Let's say the market doesn't crash. Well, you want to know that you're still in a position to actually earn money. Number three, you want to know, you want to know that your money is going to go to your kids probate free. Has anybody had the misfortune of going through probate here? It's expensive. It takes money. Siblings fight with each other. Ultimately, it's just a legal process of courts and lawyers and judges dividing up your assets after you're gone. Inside of an annuity, your money avoids probate entirely. It goes to whoever you name as a beneficiary. And if one of your kids makes you mad, you can change the beneficiaries after it's already issued. Right, and last but not least, and I would say this is probably the biggest selling point when it comes to annuities, they offer a lifetime income that you could never outlive. Kind of like a pension, kind of like Social Security. You turn it on, and it doesn't matter if you run out of account value, and then you live another 20 years, or as long as you're alive, that income will come, rain or shine. And so, for this reason, most annuities are going to have those components. Some might not have the income, but a lot will. And once you learn one of them, kind of like once you learn how to drive one car, you have more or less learned them all. And one of the biggest sources of hang-up that I will see from new agents, they will say, well, this is a 401k, it's never been taxed before. I want to move this over, but I don't want to screw it up. Right? I don't want to make this thing all taxable all at once. I don't want to get in any legal trouble with the client or anything like that. I was thinking, and you know what I came to the conclusion of? You guys have to bear with me here. I came to the conclusion that I love cereal. Can I get an amen?
Yep.
Man, I love Cinnamon Toast Crunch.
Yep. Captain
Fruity
Crunch.
Pebbles. Someone say Captain Crunch?
Yep.
That's close to home right there. But I love cereal. And part of the problem that I think we have when we're looking at these plans is there's 401ks, there's 403bs, 457, TSP, IRA, Roth IRA, Simple, SARSEP, and it sounds like this jumbled mess. It sounds like you took a bunch of Scrabble tiles and you threw them on a table and you said, all right, these are the names of our retirement accounts, right? The other day, I decided I wanted to reminisce. Back when I was a kid, I used to eat alphabet cereal. I don't know if you guys have ever seen this, but it's a bunch of letters and you pour it in the bowl and it starts making words as you're eating it. I poured a bowl the other day, and I'm not joking you, this is what I saw. A jumbled mess of letters that didn't make no sense. Is that right?
Yep.
But here's the truth. This thing just ain't that difficult. Right? It's much simpler than you might think. I don't know if you guys have ever had a bowl of alphabets, or maybe if you've ever had a bowl of 401k cereal. And this is brought to you by a company called For Profit. Right? If someone worked at Walmart, if they worked at Amazon, if they worked at Home Depot, and if they got a retirement account, guess what? They got a 401k.
Yep.
All I had to know that was that it was a for-profit company. But let's say you wanted a delicious bowl of 401k cereal. What do we need to get first? What did you say? A bowl. A bowl? That's true. We need a bowl. We need milk.
Yep.
We need a big old ice cold gallon of rollover milk. Right?
Yep.
And if you want a bowl of IRA annuity cereal, you take your 401k, you get your rollover milk, and you make yourself a bowl. Now, let's say for a moment you don't have 401k cereal, but you had 403b cereal, right? Brought to you by a company called Nonprofit. Someone worked for a church or charity, they might have this. If you wanted to roll that over and create your own IRA annuity bowl of cereal, what do you need first? You need the milk. Man, you guys are catching on. You need the rollover milk, and you pour yourself a bowl, And here's what it looks like. When we do a rollover from one of these accounts, it is a quick phone call with the plan administrator. Let's say your 401k is through Fidelity. After we get you approved, we make a phone call with the client on the line, and it's done. They send the check, we wipe our hands, and go on to the next case. That's not complicated. That doesn't take days or weeks to do. That's like your lunch break, one half of your lunch break, you get that knocked out. Well, let's say you didn't have a bowl of 403B, you had a bowl of 457 cereal. I'm telling you what, if you had never had this cereal, this is a great cereal. This will take me back. This is brought to you by a company called Municipal. If you want to roll this over, what do we need to get first? Milk. The milk. Man, you guys are great. We'll roll over milk. We pour ourselves a bowl of IRA annuity cereal. Last but not least, you can never forget the OG, TSP, the Thrift Savings Plan cereal, brought to you by a company called Federal. Someone help me out. What do we need before we pour a bowl?
Milk.
The milk. That is right. Thank you. The rollover milk. And then I can't mention this list without mentioning another one of my favorites here. Another one of my favorites, IRA cereal. Before we pour a bowl of this, what do we need? What kind of milk? I tricked you guys, I'm sorry. Transfer milk. When we're moving an employer-sponsored plan, our 401ks, 403bs, 457 TSP, it's called a rollover. Remember, it's just a quick phone call. When we're moving over an IRA, and we want to make a bowl of IRA annuity cereal, we do what's called a transfer. Transfer is a little different. You just fill out one form. You send it in. The receiving custodian will go and get the money for you. That's it. We need one signature, fill out one form. It just ain't complicated, right? Let's say, we want to get a little nuance here. Let's say we're moving over a non-qualified, so a non-retirement plan, non-annuity cereal. This one's a thinker. What do you guys think we need first? What kind of milk? Now, trick you again, I guess. It's going to be the transfer milk. There we go. And we're going to make a bowl of IRA annuity cereal. And last but not least, if we're moving over, let's say a non-qualified annuity, what type of milk do we need? Oh, I'll trick you one last time. This is going to be a little funky milk. This is 1035 exchange milk. Yeah, I'll tell you what, this milk, it's like a shot to the head. 1035 exchange milk. We're going to pour ourselves a bowl of annuity cereal. And that's how we move it over.
Yeah.
And really, that's it. That's, when we're talking about the places that money comes from when it goes to an annuity, if it's not one of these places, it's just coming from a checking account. What do you do then? Just write a check, right? And that will cover 99.9% of all sources of funds that could ever come to an annuity. So once again, just to recap, if we're moving over a 401k, 403b, 457 TSP, what type of milk do we get?
Rollover.
And what does it mean to get the rollover milk? It's just a phone call. One phone call you make with the client. If we're moving over, remember our IRA cereal, what type of milk do we need?
Transfer.
We need the transfer milk. And what do we need to do that? Just one, a transfer form. Thank you. If we're moving over our non-qualified, if it's not coming from an annuity, once again, that's just a transfer form. And last but not least, if we're moving it over from a non-qualified annuity, we just need our 1035 exchange milk. Right? And that's it. And you guys may have noticed on each of these boxes of cereal, there's some nutrition facts. Are you guys curious what makes up one of these cereals? I know I was. So I went to Google and I Googled it and I said, hey, what are the nutrition facts on this? Right? What makes up an annuity? You might notice that really just ain't that much. We have our bond rate. We have a few expenses that the carrier pulls out. They need to make their profit. They have their own expenses. They got malphas. They got to pull out a little bit for agent commissions. For the most part, that's about it. And I'll tell you guys, this is important to know because A lot of annuities that I show my clients, they don't have fees. And the client's looking at it and it's like, well, the company's making money. I know you're probably making money. Where's it coming from? If it's not a fee, how was it built into the cake, right? And so here's really what it looks like. So let's say you started with $100,000, right? That's your policy premium. The first thing the company is going to do is they're going to take it and they're going to put it in boring, plain old, high degree of safety corporate bonds. These will put an institutional investor to sleep type bonds, right? And those bonds every year are going to generate some interest. And what the carrier is going to do is they'll deduct their expenses. So first and foremost, they got an office, they have a staff that has to answer phones. They're going to take out a little bit for agent commission. They'll take out a little bit for their profit. And what's left over is our fixed rate. And this is basically what buys our index, right? It's just our fixed rate. Another way to think about indexing is really what they're doing is just buying options on your behalf. But a way I like to explain it, it's kind of like if you went into a gas station with $1 and you bought a lottery ticket and you take it to the end of the counter, you've got a scratcher, and you scratch it off, and let's say you win. Well, you won $5, right? But what if you lose? What'd you lose? Just the dollar you came in to buy, right? And so that's how we're able to guarantee that our clients will never lose money if the market drops, because their money was never put in the market to begin with, right? It was the interest off of their money that bought the index. So another way to say it is, we're only ever risking the milk, never the cow. And here's one last analogy. I love using this, and I'm going to preface this by saying I'm from Kansas City. You guys know what NFL team I like. Go Chiefs! That's it. Oh, who said Eagles? I'm a Chiefs fan. Well, let's say you guys started your own football team, right? This is the Indexed Annuity football team. And man, you guys are good. You get the ball on the 20-yard line and you throw a forward pass. Right? You throw a forward pass down 15 yards. Right? Well, you don't get the full 15. Remember, you're the Indexed Annuity football team. Instead, you only get 10 of those yards. There we go. We only get 10 of those yards. You said, hey, that worked out pretty well. I'm going to throw it again. We throw that 15-yard pass. Well, we only get 10 of it because remember, we're capped. You decide, hey, this air attack is kind of working. I'm going to throw for another 15 yards. I get another 10. And now you want to start getting fancy. You decide, I'm going to throw a 30-yard bomb down the field, right? So you throw it, and it gets picked off and intercepted and taken to the end zone. Right? But your coach, man, he's sharp. He knows the rules of the Indexed Annuity football team, and he throws the red challenge flag. Right? And he says, hey, we're the Indexed Annuity football team. We never take a loss. Right? The refs get out, they huddle up, they say, you know what? You're right. No touchdown. As a matter of fact, you get the ball back where it was intercepted. Back where you lost it, you just start right back over. Right? And what do? You decide, well, hey, the air attack is working. Throw another 15. I'll get another 10 yards. And you keep marching down the field until you win. And truthfully, that's how we win in retirement. It's by never losing. We win by never losing. We get slow and steady growth. But now, let's say, for example, you might have noticed on the other slide, I was talking about a bonus annuity. If you're curious how a bonus annuity works, before we started on the 20-yard line, right? In this scenario, say we have a bonus annuity, we're going to start on the 30-yard line. We get to start an extra 10 yards downfield just for free, right? It's free yards. But now you throw a pass, let's say you throw your 15-yard pass, instead of getting 10 of those yards, you are going to get 5 of those yards. And you're still going to go down the field. It's just going to be a little bit slower than what you're doing before. You throw another 15-yard pass,